Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Well, Embassy REIT is the stock on our radar. Posted a good set of Q1 numbers. Revenues and net operating income, they jumped 10 and 9% respectively. In fact, the company has guided for net operating income growth of around 13% on a YOY basis. To discuss this and the outlook going forward as well, we have Aravind Maiya, who's the CEO of Embassy REIT, with us in the studio. Aravind, it's a pleasure to have you with us. You've braved through the Mumbai rain, so definitely that's something to talk about as well. But good set of numbers, and you know, after Q4 you were not very sure about the guidance, but Q1 you have given a guidance for FY24.
Yes.
What changed within that quarter? Is the outlook looking more positive? Are the deal wins better in terms of commercial real estate?
Yeah, good afternoon. Thank you for having me on the show. Good way to start off the conversation straight with the guidance point. I think what's happened is, when you look at the quarter which has gone by, 2-3 important points. Number one, we did a lease up of around 1.1 million square feet. And when you look at the spreads, we achieved very good spreads of 68% on the new lease up. The second thing is, we did a pre-commitment of close to 4,50,000 on a building to be recently delivered. And these are two deals in excess of 2 lakh square feet. These were deals which you were not seeing last year. So there's a sudden, rather a slow shift towards larger size deals, which were not prevailing, let's say, last 18 months. And third important thing is, when you look at a pipeline, as of June, we're looking at a 2 million square feet pipeline. Again, another important point over here is, a large part of the lease-up for the quarter, as well as the pipeline, is from global captives. Now, that's a big story which is playing out positively, which we can speak further on. And the last part is around the interest rate. When we gave Q4 numbers, we were still not sure of where it is headed, but I think there's some amount of stability on that. So when you take all of this together, we were comfortable in giving the guidance for the full year.
So in the current quarter, the lease was 1.1 million square feet. For the full year, it's 6 million square feet.
Yeah.
And this is based on the 4.5 in terms of the commitments that you have in the future. Can you talk about how you've arrived at the 6 million square feet guidance?
Sure. The 6 million has three components. One is the 4 million square feet of new lease up. Yeah. Then there is a component of 1.3 million square feet pre-commitments on future deliveries. And then there is a 0.7 million square feet of renewals. Okay. So that adds up to the 6. When you compare the 6 to the 1.1 which we did this quarter, it's around 450,000 of new lease up, 450 of pre-commitments, and 200 renewals. And taken together with the 2 million square feet of pipeline, that's where it gives us a decent amount of visibility as we look for the remainder of the year.
Okay. So, while we are talking about additions happening and growth guidance looking good as well, there have been some exits as well. We have been talking about the slowdown in the IT space. In fact, the exit pipeline has increased by 0.3 million square feet. That is to 2.8 million square feet. Is there something to worry about? What would the possible risks be here?
Yeah, the way we look at this increase from 2.5 to 2.8 is what we call as BAU, or business as usual. Just to look at some of the stats, right? Over the last 5 years, the expiries from the beginning of the year to the end of the year, on an average, has increased by 175%. Okay. All right? Some of these expiries are not necessarily exits, they end up being renewals as well. Okay. But the most important point is, as people exit, we are able to capture what we call as the mark-to-market. If any tenant leaves earlier, we are able to capture the mark-to-market much ahead of time. And two important points over here. One, as we shift from IT space to global captives are not sensitive on rent, but they're sensitive on the quality of the space, which is where we are able to differentiate, right? Number one. Last point is, just when we look at Embassy Manyata, which is our largest asset, in this quarter, we delivered about 6 lakh square feet of buildings which were refurbished, where an old tenant, IT tenant, vacated. We were able to lease about 50% of that in the same quarter at 200% plus spreads. So the rentals moved from 30 odd to 100.
Oh.
Right? And Embassy Manyata as an asset, when you look at the in-place rent, it's increased by 20% in the last 18 months. So somewhere, as occupiers churn, which is part of our business, and better occupiers come, I think it works out beneficial in the long term. Of course, in the short term, you end up having the rental void.
Just talk a little bit about this trend about more global captive centers, GCC, driving up demand for you. What were the numbers earlier in terms of how much did they occupy of the overall available? And currently, you said it's at 71%. And IT share has been coming down.
Yes.
Just give us the numbers over a 5-year period.
Sure. IT share, just to start with, was around 25% of our portfolio when we listed about 4 years back. 4 years back. Now that's dropped to around 14% as of today. captives has increased to 55%. It was at mid-40s 4 years back. But what's happened, if you look at Q1, 71% of the new leasing is from captives.
Okay.
A large proportion of the pipeline is from captives. So as and when more captives are coming and taking up space, this 55% also will keep going up. And, it'll work out beneficial. And just to talk a bit more on captives, probably for 30 seconds more, when you look at all the industry data, there's a significant shift on what's happening for captives in India. It's no longer back office. These are what they call transformation hubs. The number of captives are expected to increase to 2,500 from 1,700 in the next, say, 7-8 years. More importantly, the number of people employed in captives will increase from 19 lakhs to 45 lakhs. So logically speaking, the amount of space they'll take up has to increase, more than 2x in the next 7 years. So I think all in all, while we've had a bit of pain over the last 2.5 years because of COVID, when you look at it more medium, long term, I think we are well poised for growth.
So what does it mean in terms of rentals? You said the exit that happened from the IT industry was taken up by a GCC at a premium.
Yeah.
How will the product mix, what will the product mix look like, say 2 years down the line? You have the hospitality segment as well. What will the split look like, and will that mean higher rentals for you?
Yeah, so there are two different components here. One is the tenant mix, right? Captives, I think, will continue to increase, and if the same trend continues of, say, 70% captives every quarter, you could end up with a similar number for the full portfolio. Difficult to define a time period by when we'll reach there. Coming to hospitality, that's what we call as an amenity within. We are primarily commercial office, right? But having a hotel inside a park, along with various other amenities which we provide, gives what we call as total business ecosystem, right? So hospitality today, we have 4 hotels in our 3 parks. We're building 2 more, and it really enhances what we call as the moat of our properties. So, just talking a bit on hospitality, we were able to increase the occupancy in hospitality up to 53%, but more importantly, the ADRs have increased by 30%, with still only around 50% back to office. So you can imagine, as more people come back to office, because these are hotels inside a park, they'll get taken up much more.
Okay. You've also in the call said that large RFPs, the requests for proposals, have remained muted. Will this not hurt the future growth?
I think from an RFP point of view, it's changing a bit, right? While large RFPs were put on hold, and some of them continue to be on hold, but quite a few of these RFPs, especially captives, have opened up. And some of these are included in the 2 million square feet of pipeline what we've disclosed. So we are seeing a sudden shift. To put it very frankly, I think there is a bit of pause or delay in decision making, because ultimately most of these are headquartered, let's say, in US or Europe. It requires the global CEO's approval. So they will be a little more cautious. But looking at the growth, just to take one tenant in Manyata, 2019 they set up 38 employees. Today they have 4,800 employees. They're looking to grow to 7,000 in the next 2 years. Logically, they need space. It's just a matter of time by when they'll take up the spaces. Yes.
Okay, so that is something that will be interesting to track as well. I wanted to check about your distribution, because you've seen an increase in your net operating income, but distribution has been flat. This is something that the investors are most interested in as well, right? What happened here?
Yeah, just 2 things. One, the NOI for the quarter is up 9%.
Yeah.
Now, NOI represents the growth in business.
Yes.
Again, of the 9%, 6% comes from the leasing business and 3% comes from the hospitality business. The 9% has not necessarily translated to distributions for 2 reasons. One, the interest cost has gone up from last year to this year because the average rates have gone up. That contributes to, let's say, 40% of the reduction. And the balance is what we call working capital changes, which are business as usual again. On a quarter-on-quarter, it can vary. Just to give one example, property tax is one significant expense. We sometimes end up paying that for the full year in the first quarter. So there can be variations within the quarter, but you should look at that on a year-to-year basis.
So for the year, what would the distribution look like? So
when we look at the full year guidance, what we've given now, the NOI again is expected to be up at a midpoint, 10%, but distributions will be, approximately 2% lower at a midpoint. Again, 2 reasons. One, the interest, increase in interest rate on a average, it's expected to increase by 60 to 70 basis points on the entire portfolio. That will contribute about 50% of this reduction. And the balance is what we call as non-cash revenue, because a lot of the 6 million square feet lease up will not translate to cash revenue this year, because there will be rent-free period, but it will automatically translate to cash rent in the next year.
Okay.
Aravind, we'll have to leave the discussion here for now. Thank you very much for joining us
so
in the studio.
Pleasure being here.
And wish your embassy stint the very best, the first one. as
Thank you so much.
the CEO. We will slip into a very short break. We'll come back and talk more about the individual stocks, markets, and stocks like Birlasoft, which are reacting to their numbers. Stay tuned.